Welcome to Think Learn Finance. By the end of this video you will take away the following. The basics of what a share actually is. The benefits and potential risks of owning shares. What dividends are. And the main 3 investment strategies present within the market. Let's start by taking a look at the basics. So, what the hell is a share? When you purchase a share, you are purchasing a unit of ownership in a company. You can think of this as your slice of the pie. It really is as simple as that. When you own shares in a company, you are entitled to a proportionate share of the company's profits if the company pays a dividend. We will cover dividends more in a moment, but this means that the company will periodically pay you when they do well, as a thank you for being a shareholder. 1 share equals 1 dividend right. 2 shares equals 2 lots of dividend rights, and so on. Therefore, if the dividend announced was 5 pence per share, and I had 10 shares, I would receive 50 pence. You also receive certain voting rights and other privileges, such as shareholder perks, like discounts on products, which we will discuss in a moment. Shares are typically bought and sold on a stock exchange, where the price of a share is determined by supply and demand. Therefore, if the share price of a company you own goes up, your share is worth more, you can then sell your share for a profit. Let's take a deeper look into share types now. There is more than one type of share. There are several different types of shares with several subtypes that a company may issue, but don't be alarmed. The main 2 types that you will come across in your typical retail investment journey are ordinary shares. These are the most basic, most common type of share, and these will be the main focus for the rest of this video. Ordinary shares represent a slice of ownership of the company. They allow the owner a share of the company's profits if the company pays a dividend, as well as certain voting rights. Voting rights means that you are able to attend annual meetings in person and vote on company matters. However, in reality, very few people actually go to these, apart from company directors and institutional investors. On the plus side, there usually is free food and drink. Preference shares, these typically have a fixed dividend, which is paid out before dividends are paid to ordinary shareholders. Preference shareholders also generally have priority over ordinary shareholders in the event that the company goes bankrupt. However, these do not have all of the benefits that ordinary shares possess and require special investment strategies to truly become useful to an investor. Other types of shares include specialized shares such as restricted shares, employee stock options, warrants, non-voting ordinary shares, and many more. We won't cover these as they are beyond the scope of this video. However, should you be interested in these, please reach out and I can possibly do a video on these. We have touched upon dividends, so let's explore them now. So, what the hell is a dividend? Dividends are payments made by a company to its shareholders out of its profits. Companies pay dividends as a way of saying thank you to their shareholders. There are also other benefits for the company to do this, but this is outside the focus of this video. Dividends may be paid in cash, or they may be paid in the form of additional shares, a process known as stock dividends. The amount and frequency of dividends can vary significantly from one company to another. Typically, they can be paid twice a year, whereas some companies might pay dividends twice a year, with a special additional dividend payment taking place to bring the total number of payments to 3, but this is up to each company. Be aware. Not all companies pay dividends. Some companies choose to keep all of their profits for reinvestment into the company in order to provide growth within the business. Companies that like to do this are usually tech-focused. Companies that offer dividends can also stop paying dividends in times of uncertainty, in an effort to keep money within the business. We saw this on a mass scale during the COVID-19 pandemic. This can very quickly disrupt the income generated from investments and harm a group of investors, known as income investors. We will now turn our attention to why people invest in shares. So, what the hell could go wrong? Some of the potential benefits of investing in shares include the potential for strong returns over the long term, the ability to participate in the profits of a company via dividends, the ability to sell your shares for a profit if the price rises, due to periods of good market performance, in the short term. Also, something to be aware of is that some companies occasionally operate share buyback schemes. This is where companies may repurchase their own shares from the market, which can increase the value of the remaining shares, which is really good for the remaining shareholders. However, investing in shares also carries risks, including the risk of losing money in the short term if the share price declines, or even the risk of complete financial loss if the company goes bankrupt. In the industry, we call this going to zero. I will be doing dedicated videos on risk management, and diversification, as these are very important topics in their own right, which all investors should research, study, and understand in order to be successful. Now let's take a quick look at the broad investment strategies. What the hell are the main three? There are many investment strategies, but we will focus on the main three. These are value investing, growth investing, and income investing. Please note that how to implement each strategy can be done in a multitude of different ways, and finding the way that works for you is a personal matter. As a result, I will do a separate video on how to design and execute your own investment strategy. For now, what the hell is value investing? Put simply, value investing is the process of investing in companies that are said to be trading below their intrinsic value, and then holding the shares of these companies until they rise beyond a suitable level, at which point the investor would look to sell. Intrinsic value can be described as the real value of a company, despite what the current share price might suggest. We will cover ways to calculate intrinsic value in another video. What the hell is growth investing? Growth investing is more focused toward investing in companies that are likely to experience strong future growth. As a result, growth investors are more likely to pay a fair, or even a higher price, for their company of choice. This is because they believe that it will soon expand rapidly, and that they can ride the resulting wave that comes with that expansion, leading to profit. They then hope to sell around the peak of this expansion. Finally, we have, what the hell is income investing? Income investing focuses on generating regular income from dividends and income-producing investments, such as bonds, which pay a regular fixed amount to the holder. This type of investor isn't concerned with growing their portfolio value or making big returns on their share trades. They are focused on creating a portfolio of assets which forms a stable, regular income that tops up their current salary or other income streams. They will not typically sell their assets just because their share price has gone up or down in value. The deciding factor of whether or not they should sell or replace an investment for this type of investor is how much income that asset is providing them, and if this has decreased or stopped since their last strategy review. If you learned something from this episode, please hit that like button and subscribe. Don't forget to check the bell icon to be notified of our new videos. And remember, not everything that shines is gold. Catch you in the next episode.